So let's talk about Ethereum. Recently, investors were buying Ethereum on this deflationary narrative. When it came into senses, when turned out it's not as easy as it looks, the bulls has stepping out. Right now, they are still not giving up because there are some aspects that may prompt them to buy this in a recent manner, but can eventually bulls seize the initiative and fight the bears. So what's up for Ethereum? Today there will be a episode dedicated in terms of two sections for Ethereum aspects of trading and investing, and it's 8:45 New York's time. Let's get into another episode. So we are jumping to economy view, and right here we can find that we are still struggling with this jumbo rate hike being delivered to the market. There is still a long way ahead for developed markets. Many of them are expecting 2023 to hike interest rates, but some of them are stopping for a while. And so the basic fact is that the longer inflation remains well above the target, there is a higher chance that more and more companies will eventually incorporate higher inflation into their economic decisions, and that's something that is really devastating for the economy, as if we find ourselves in this new environment of a boosted inflation, there will be a destruction of a saving purposes, and that's why there will be more and more impoverishing tendencies around the economy. That will be, on the long run, something that may prompt many of public decisions get eventually down, in order just as we may find the problems may persist for longer, and eventually will squeeze this develop possibilities in the years to come. So there will be very difficult to lower down, as average inflation rate already found some problems. We are just ahead on this curve that is rather more likely to bend this interest rate average to about 4.5% or even higher, but it's nowhere here from stopping. In terms of what the problems it may also entail, is this problems of indebtedness. So right now, United States has gone through a much higher debt to GDP rate, and that also prompts us to think that with this one, that may get this inflation may get much more difficult for the economy, as the higher indebtedness brings to a lower chance of paying down their debts. So we are seeing across the world economy right now that this commodity-driven dislocations, this supply issues bring in the scenario where interest rate hike are not sufficient, and there is very difficult to make quantitative guess as to where inflation is going over in this and next year. So the Fed cannot really answer these supply side questions. They can only diminish the to some extent, of course, the demand, but supply is unsolved for them. However, even if central banks not finding a way to stop down this interest rate hike consecutive series that they are just going through, there is one of the bank that is becoming one of the outliers that right now is finding out its way to get out of this steepening curve, and eventually finding that there will be a much more desirable to lower this interest rate hike as of very soon. So there is a strong case for the Australian central bank to slow the pace of tightening, to give more time, especially to assess its impact to economy so far. As though we cannot say the same about the Fed, that recently is really playing with fire more and more. So RBA is among the first developed world central bank to signal a downshift in tightening, as they noticed some of the possible breaks around households and also the mortgage risks that right now the Fed around is playing blind, really. So can we really get out of this? The supply chain problems may be getting over, as there are some signs we are easing at this aspect of inflationary pressure. Chip delivery times shrank in August, and some of the technology, some of the IT and also semiconductors companies CEOs claiming that the wait for some elements recently has shortened, but still some of them remain extended. So many component costs are getting cheaper. The availability has recently improved, and don't forget this one, that demand has weakened. So right now supply is possibly up, but demand is down. So that's also something that may bring some more positivity to the markets, but it's still too early to say that we are getting this over. In terms of market outlook, we are jumping to some of the projections made by Guggenheim that found that since 1960s, PEs have trended lower when inflation was higher. So that's the one of the element that shows us that with the PCE right now at around 4.6% and also about S&P 500 trading at 19x, we may get down to this difference of 19 and 4.6 that will get us down to 15.2x, and that will be something as even up to 20% fall by mid-October. So that's the projection. I just skip one of the slide, but that's the projection that depicting this one. So seasonal suggests a challenging period ahead for earnings revision, and everything gets down, whether it's some projections in seasonality of Bitcoin price or major indexes right now, that those earnings revisions may get these valuations even lower. So is it the last dip ahead in the late October and early November, just before commencing this Santa rally of 2022? It's remained to be seen, but that's very interesting that we haven't seen a 0.5. Maybe I'll just show you up. So if we just jump to trading view and looking at SPX, we have crossed this 0.5 level that remains to be considered as the level one been found with a getting over a correction and reverting to the previous following trend of north one, but this time, if we may broke those lows in order to get another 20%, that will be a first time in the history of stock market where after correction been gone through over 50%, we will drop after correction, after such steep correction that took around 20%, that after such recovery, that significant recovery, we may see a drop below a dip. So it will be very difficult for bears to get it through, as there are many support levels yet to be possibly tested out. So for now, that's kind of a braced really projection of the one that we may get through those two supports, break them, and right over had something around below 3,400 or even lower to 3,200s. So as of now, it's too early to say, but definitely there are some signs that this September will be much more difficult than many assume. Rule of 20 that finds that markets tend to following the sum of the PE ratio with adjusted by inflation rate. Right now, also finding out that we are still nowhere near from this level of valuation around 20s. That's why we cannot really qualify the recent correction as the one that may be ending some of the cycle. So we are still in this bull market with a very steep correction, but we are still on the way possibly up, and another fly in the ointment might be that throw a bearish something that throw a bearish light on the matter is that those valuations tend to eventually get to those 20s area, and that will be over 20%, even over 20% of a drop from here. Those seasonalities we have discovered is that 60-40 comeback that gets down to the wallet consisted of 60% of stocks, equities, and 40% of bonds. So recently we were going through very difficult time for both of asset classes, but right now after so bearishness over there, we may get through eventually to bonds that usually tend to perform very well during recession time. So during the slowdown, there were the most favorite one commodities. Right now, this tendency tends to turn to bonds side. In terms of crypto outlook, let's have a look at eventually our topic issue of Ethereum. So what I just really get down to is that many of investors expect that Ethereum after this 2.0 merge eventually occur, that will get down in this immediate herald of new era of deflationary supply for this chain, but it's not entirely true. For now, at least, as this demand is not as it was back in the second half of 2021, there is more bigger likelihood of that this inflation eventually get lower than what happened with Ethereum 1.0, this proof of work chain, but there is still a burn rate that really adjusts itself to what the demand is. So there is also a conclusion that miners' rewards will be of 20% of previous. So that will be also a this miners' pressure, but it will be diminished one. So many investors were buying Ethereum in order to have this deflationary edge in your crypto wallet, but it's that was kind of a narrative, kind of a headline that was pushing the price higher, but eventually wasn't the entirely true one. So in which of four market phases are we? That's the question for you. If you have such of a suggestion, just put it in the comments. Just what I think is we are somewhere around declining phase and accumulation. So when we will enter the first phase again, and this decline will eventually stop. That will be that what we need is this pre-halving rally about to begin, and for that to happen, we need to get over this very difficult time with this extremely high electricity prices right now hitting the market. So as of now, with all costs taken into account, only the miners with this very low electricity margins are running at a profit. So that is why even if we just observing increasing of hash rate on Bitcoin, literally those miners don't really come into the conclusion that they might not be profitable throughout next few months, and those are those increases in hash rate literally boils down to that supply chains disruptions, and eventually that lots of mining equipment has been delivered of recently. That's why there's a kind of a lag between those orders being made in 2021 during this bull market, and those deliveries that eventually took place this year. So there is a strict concern that when those miners eventually come into senses that they are no more profitable by switching on their mining equipment, there will be much of a drop in terms of hash rates once again. And the possible pivotal moment for the entire crypto market will be will get before this pre-halving, or before this halving to happen, that usually takes up to from 12 to 18 months before the halving, when the rally have its commence, and when this energy crisis will eventually get over. Otherwise, there will be very difficult to get it through. And there's interesting topic. What about getting rewarded for making KYC? KYC is the Know Your Customer procedure, where you are delivering your personal data in order to get an access to kind of a exchange. Recently, the KYC procedure has been hated so much by crypto users, as even those decentralized exchanges that by the definition, decentralized exchanges are some of the constructs that bring in rather more anonymity by its bringing more anonymity rather than I would say centralized type of procedures. And right now with DiDEX there was a kind of a issue where the governors of DiDEX has prompted its users to complete a liveness check using webcam technology, and that was an outstanding procedure that has never been provided by any of decentralized exchange unit. So many of investors that really respect the anonymity and want to really save the feature of anonymity by transacting tokens, recently been really spooked by such phenomenon. And recently what happened on Binance don't already know that those regulations are something that cannot be staved off, and that's why they are also trying to not really push off investors and their customers that put an emphasis on those anonymity issues, but know that they need to really implement many of these features that will comply with regulatory procedures. That's why they in exchange are delivering their customers those soulbound tokens that will allow users to participate in building projects and becoming kind of a unit of a decentralized society. But what will be the possible advantages for the users to be really straight, I don't really know yet. But if you are really finding such of a exchange of getting soulbound tokens, the new tokens of an exchange, instead of leaving your personal data, that will be something you may consider to take. That's kind of a free possible token to get. That's the one that is unchangeable on the market, but that should provide users with new elements. So getting to market mover section, that's interesting of what the newest elements will look out. Recently we had inflation rate from China, and it's still on a satisfactory level. That's why they are nowhere near from stopping themselves from using this stimulus that will be possibly rolled over this month. In terms of initial jobless claims in US, they're still on the level that is right for the US economy. So that's something that also pushing the market and the Fed to hike interest rates even further. In terms of Friday, we are still awaiting Fed's members' speeches. Yesterday, we also had what I was about to mention, the Fed Powell speech that was showing no hesitance in further interest rate hike in September. That's why many of economists are waiting even 0.75 points interest rate hike at this month. So we are jumping right now to the section of trade idea. And in terms of trade idea, let's have a look at Ethereum, one being promised. So we are trying to get through the trading board I've set back in the beginning of September. We are having this difficulty. I would right now expect the possible correction right after this impulse that brought around 16%. But if we manage to on a 4-hour chart to get over this threshold, I would possibly make a bet for another 20 or around even around 20 percentage points of growth. If we just have a look at some elements as what's behind the chain right now, there's exchange reserve that right now has on Ethereum has collapsed. And collapsing again. So that's something that bringing more, I would say, more bullishness as those tokens has been taken out of the exchanges in the some of the scenarios, and that may be that one that where the investors are more likely to having and keeping their tokens for a long term. But it's not a very, very polarizing trend and not very strong one. That's why I wouldn't consider this one as very important for the measuring of a possible pivotal moment. In terms of, however, Ethereum active addresses, we've seen a slump previously in the second half of August, and right now we are getting over and possibly starting to build another impulse in this element. So so for now those are the most important aspects in terms of funding rates on Ethereum. We are somewhere of an area of hesitation. If we just make a look into aggregate, we are more likely bearishly concentrated rather than bullishly. So I do expect for Ethereum to spike to at least those levels of 1855 with this merge to eventually happen. But as we are kind of extended on the chart right here with this RSI crossing over 56 on a daily basis, and as we are getting to 70ish on 4 hourly, I would expect to calm down the course of Ethereum, and right from there I would switch over. Right from there I would expect such of a move to happen with risk reward ratio of 3, so it's still satisfactory. So that's my viewpoint on where Ethereum may go. I do expect that with this short term to medium term risk on tendency, we may have a spike, and there is still somewhere around 20% of profit to be grabbed off the table. So that's it in today's episode. Thank you very much for watching, and see you on Monday. Remember about liking if you have enjoyed, and subscribing for more updated content. Bye bye.